This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. It's the week ending January 9th, and 2026 is off to a pretty busy start, so let's dive in. A few of the highlights this week on the macro front. The largest U.S. banks are expected to report bigger fourth quarter profits next week. The ADP jobs report showed slightly fewer private sector jobs created in December than expected. U.S. manufacturing slumped to a 14-month low in December, and holiday spending was up but more value-conscious. Manus, what's your take on the week's market news?
Well, it was one of those weeks where your head really spins and you don't know really where to start. This seems to happen once or twice a year where things come out of left field that are unexpected. Certain things that you mentioned, we get into a very regular cadence. We see that ADP jobs report every month. We see manufacturing statistics and PMI and bank earnings every quarter and so forth. So you get into a routine. So even though sometimes those numbers can surprise us, at least we know that they're coming. But this week we saw several news items that just really kind of rocked everybody's world. The first, of course, being Venezuela. There had been talks for a long time about the tension between the U.S. and Venezuela. We had seen talks about perhaps the military going into Venezuela, but I'm not sure anybody was really focused on it, and nobody thought that this was going to be imminent with the removal of a foreign leader. So, that had several follow-on effects. We talk about oil prices first surging really after really it being in the doldrums for many, many months. We saw headlines about Venezuela selling the U.S. $50 to $100 billion in oil, and all of that came out of left field. Stocks rallied initially on the news. Why? Hard to get your arms around why. And that's one of those things that once or twice a year you get something like this and you just scratch your head and say, wow, I didn't see that coming, and I'm not sure what the long-term impacts are. The crazy thing about this week is that we saw 3 or 4 of them. We saw yesterday President Trump coming out, some of his staffers coming out and saying, we are going to put an end to the single-family rental market. We are going to remove the ability of large corporations to corner the market on housing communities and rent out single-family properties. I know Dianne and I will go through that a little bit later, but that was a little bit earth-shaking. And then today we saw a headline which said the president is talking about instituting a $10,000 tax deduction on interests for automobile loans. And all 3 of those he could put in the category of didn't see that coming. Oil companies, car makers, home builders, the U.S. consumer, prices of things. And I almost don't know where to start, Dianne. I don't know where we take this. There's so much going out there. And I think I need a few days to digest all this to kind of make my predictions about where we go from here.
I know, Manus. I know. Feel like we might need to do a double episode on this one. You and Alyssa mentioned a long list of headlines, and in my mind, I kind of dropped them into 3 buckets. I have my encouraging news bucket. So that's, the big U.S. banks. They're expected to post strong Q4 profits next week. So I'll take that as a good backdrop for broader lending and transactions. We saw holiday spending come in pretty solid, although there was a slant toward more discount buying. There was a slant toward more kind of buy now, pay later, which isn't necessarily good, but it still reinforces that consumer demand hasn't completely petered out. In the bucket of concerning news, I put the ADP jobs report that missed expectations. I put news that manufacturing slipped to its lowest level in over a year. So those are reminders that not all segments of the economy are firing on all cylinders right now. And then, what I call the head scratchers, which you just talked about. I took a long holiday vacation, I will say, and I did not really check the news while I was skiing and at the beach on Cape Cod. So I came back Sunday to these head scratchers, like the New York City mayor challenging a large rent-regulated portfolio sale. I have so many questions for you on that, Manus. And then, like you said, the federal pullback on large institutional investors buying single family homes is another one that I probably have 10 questions on. I don't even know where to start.
So maybe we'll go a little longer with our open. We usually try to keep this to 10 minutes, but let's try to peel back these things in categories. So let's start with the single family rental, and maybe I'll just start asking you questions and letting you react to this. I was encouraged on two fronts, although I question the legality of it all. I was encouraged by the fact that the president is trying to drive down prices, and it's not just rhetoric from what he was saying in November and December. With the single family rental, if we are going to literally drive out big corporations and say you have to basically sell off your inventory and make that available to others, that potentially makes inventory more plentiful in some of these hot markets that we've seen and could potentially drive down prices. I would say that that is kind of putting rubber to the road from the White House in terms of trying to do something which lowers prices. Again, there's a lot of details there, and forcing somebody to sell something like this or preventing a company from doing this is beyond my pay grade, right? I'm not a lawyer here, but I was encouraged by somebody actually taking a step to do something like this. And I think that the tax deduction on auto loans kind of falls into the same category, trying to make something happen. So let's start there and let's see what your reaction is to those things. Were you encouraged by this, or do you still need more time to get your arms around it?
Yes and yes. The one thing that jumped out at me in the news was the quote that I think Trump said, which is people live in homes, not corporations. So, yes, I think it's a good thing to acknowledge that there's a need maybe to level the playing field for folks, especially first-time home buyers. I love my kids, but my hope is that one day they can buy their own houses and start families, like we did when we were young. I have a lot of questions about the logistics and how it will play out. I have concerns in market interference. And then I look at the numbers and I think, okay, well, how much of our housing stock is owned by institutional investors? And right now it's about 1%. It is concentrated in metro markets. So then I wonder, will a program like this, if it's implemented and how will it be implemented remains to be seen. But if a program like this is implemented, how much will it really move the needle? And I wonder about how much impact it would really have on housing prices. And the affordability issue, a lot of that is a supply issue. Again, I have definitely more questions than answers.
It's an interesting thing. I've seen the statistic that you just mentioned too, that it's only 1% of the inventory, and that sounds about right. My guess, however, is that a lot of this stuff is centered in hottish markets, Phoenix, Southern California, places where home builders could or corporations could acquire large parcels of land. I don't think you saw a lot of this in New York, San Francisco, Boston, other places. So perhaps in some of these hotter markets, it's 3 or 4%, which if you kind of make that inventory available for sale, perhaps you do push prices down. I do think that this will play very well to the populist movement. I think people will say, this is great. Let's get this back into the hands of homeowners. But the truth is, this is kind of settled business development. For 200 years, people have been able to build multifamily housing and make a choice. Am I going to sell this as a condo, or am I going to rent this to somebody on a transient basis for a year or two? And the market has evolved where almost all of the transactions that take place are rentals in that market. And it took decades and decades for this new business model of single family rental to emerge, but it's really no different than multifamily housing. It's somebody saying, we could put up a 300 unit or 300 property single family home unit, and instead of selling it, we can rent it. And to that, in that way, it's no different legally than multifamily. So whether this stands up, whether the Blackstones of the world want to fight this, or whether they just want to say, you know what, we're not going to use our political capital on this, we'll move on, I don't know. But one of the real amazing headlines of the week, to be sure.
Let me ask you privately, Manus, because I don't know the answer. I mean, if an institutional investor owns short-term rentals, they own them. I mean, this isn't like a retroactive thing. It's the idea that it prevents institutional investors from buying homes to rent moving forward.
I think a lot of the details, you mentioned this before, remain unclear, right? Will divestiture be part of this? And it could be one of these things that this conversation elevates the topic to a level that everybody in America knows about this now. And people like Blackstone say, you know what? It's not worth the reputational risk to hold on to these things. Let's sell them off. Let's exit the business. Let's try to get a good price for these things and let's move on. Or do they fight? I don't really know. But I do know that I spoke to a big institutional money manager who had people in his organization doing this. He was a risk manager. And he would say, one of my risk management functions is trying to figure out, will the rug be pulled out from under us someday and how costly will that be? I think they've made this policy in Europe several years ago. So this gentleman knew that this was a potential risk, and it wouldn't surprise me if people like Blackstone and others just say, let's divest of this, let's take our ball and go home, and let's make this available for purchase. But I think time will tell. But I do want to pivot to another one, which I thought was just an incredible story in New York. We know that we have a new mayor in New York, Mayor Mondami, a democratic socialist or communist, depending on what you want to say. I think he's been defined as one or the other at various times. But he comes in with a very ambitious agenda: free busing, free pre-kindergarten, daycare, lower housing. And there's a lawsuit going on right now in the affordable section of the affordable housing segment of New York, where there's a big operator, Pinnacle Group, where they are declaring bankruptcy. They have thousands of units. These units attract really puny rents. The rents have been capped for many, many years at very low levels, 2% increases. The stock of this housing has degraded because the owner has had no interest in investing for a 2% rental increase. And now there's a trial going on, or a court case, where how this resolves itself, this bankruptcy, plays out. And the city of New York, very shortly after Mondami taking office, got involved. And they said, we want to say in this bankruptcy filing, we want to know who's going to buy this thing and who's going to maintain it. The properties are substandard. The owner had been a slumlord, et cetera, et cetera, et cetera. But one shocking element of this case came out with the city of New York saying the rents on these apartments are too low to sustain the physical plant of these properties. It was either a huge mistake on the part of the lawyers for the city of New York or an incredible admission. So let me pause there, Dianne. I've teed this up for you. Tell me what your thoughts are on this particular topic.
Well, my knee-jerk reaction, and I don't know if they're delaying the sale just because of the rent stabilization, but one thought that I had initially was it seems like circular logic, doesn't it? If you're looking to block a sale because you're saying that the rents are too low, but that the same policies that depress cash flow are being used to argue that no private buyer can come in and responsibly acquire the portfolio. So they're going to say it's unsellable, and what are they trying to accomplish? What does that mean for other multifamily assets? I have so many questions here.
I'll give you two responses, both probably equally cynical, and you could reply to them. Cynical response number one is, this is really amateur hour, that we have a new mayor with not a lot of experience hiring a lot of people with no experience and just making an unforced error, kind of saying that our policies are bad and saying the quiet part out loud. That's part of it. The other cynical part of me is, this is part of an argument that we want the next buyer of this thing to be able to acquire these apartments at dirt cheap prices so they can afford to put money into this. The $900 per unit that people are paying, which is probably a quarter of what the market is right now in New York, is substandard. We don't want rents to go up, but we want the next buyer to get such a sweetheart deal that these rents can sustain that project and allow for the reinvestment in it. I have a feeling we haven't heard the end of the story, but I was getting LinkedIn messages throughout the week from people saying, you can't make this up. This is a clown show. I hope it's a clown show. I hope this is not a cynical move to tie two things together. If you remember last month, they said they wanted nonprofits to be able to buy these things at a right of first refusal. Something tells me that this goes hand in hand with what argument they're making in this bankruptcy case.
Yeah, that was my first reaction too. What was the motivation here? Was this a way to move apartments into the hands of nonprofits, which was the headline maker before vacation? And I agree with you. These are early days for Mondani, and this was a platform that he ran on. So this is kind of the first test of how the market responds to something that's pretty radical, and there are a lot of eyes on it. So we'll have to see how it plays out.
So let's wrap up this segment with kind of a vibe check from you on this. We saw some positive news on the economic front and some negative news. Job starts remain puny, dismal, disappointing, whatever you have. We will see a jobs number on Friday, the first timely one in several months. Nobody's expecting a big number there. We're expecting under 100,000 jobs, so that would be equally dismal. We'll put those in the negative category. On the positive category, we saw slightly better than expected retail sales. We saw the stock market hit several new highs on Monday. And we saw, we'll talk about this a little later, lots of big commercial real estate sales over the last 2 weeks of December. Where does that leave you now, 1 week into the new year? Is the glass half full or is the glass half empty?
Well, Manus, what you did was hand me a perfect pivot to something that I wanted to share with you, which is yesterday I attended an event hosted by Crew Network, and the speaker was someone we know well. It was Spencer Levy with CBRE, and he was giving his forecast. So our listeners might remember he was on this podcast as a guest about a year ago. He also hosts CBRE's podcast, The Weekly Take. And what he said yesterday was interesting, and that was that 2025 was two-act year where we saw strong momentum early in the year, we saw strong momentum late in the year, and those kind of bookmarked a mid-year pause that was driven by tariffs. But what I wanted to share today that was really relevant, particularly given how we just opened this podcast with the mix of headlines this week, is we're dealing really with two ends of the spectrum. And at one end is the news and the fear of the moment, and we had plenty of that last year, and this year's off to a roaring start. And then the other end of the spectrum is the important word that he said was math, and that the news creates fear, but the math creates opportunity. And I agree with that, and I think we're constantly tested to remember that distinction. His take is that 2026 will be a better year than last year, but not gangbusters, and certainly nowhere close to what we saw in 2021.
For those that wonder, you saw a very smooth segue between Dianne and I, where I seamlessly teed up something that allowed her to pivot into the conversation with Spencer Levy. I have to assure you that all of what you're listening to is organic. What you hear is what we do. I'll put a bow around this. I'm with Spencer. I think we are looking at steady growth in 2026. If anything, I'm a little bit more glass half full today than I was 2 or 3 weeks ago when we did our last real non-year end or not predictions podcast. I'm hopeful because the president is taking the affordability question seriously. I'm hopeful because we saw a lot of big deals done over the last 2 weeks of the year. And I'm hopeful because it seems like these capital intensive projects like conversions and new construction, that funding is available for these still, that there's no slowing down of that spigot. So I'm certainly not a 10 out of 10 on the enthusiasm side, but maybe last month I was 6 out of 10 and now I'm a 7 out of 10.
Moving on to our data dive segment. Dianne, for this week, the LightBox activity index for December is in. How'd the year end up?
It is, Alyssa. And Manus, I think this might add a little more liquid to your glass half full cup. It's the December CRE activity index came in at 86.9. That was versus 99.4 in November. But context always matters. And the context here is that over the past 3 years, that November to December drop was in the neighborhood of 30%. And this year it was half that, a 15% seasonal drop at the end of the year. And looking ahead, we typically see a January pickup month on month in the 40 to 45% range after things like underwriting and listings pick back up post-holiday. So we'll see if that holds. I'm certainly hopeful based on everything that you just covered, Manus. And then I wanted to add, I know your team, Manus, tracks the biggest transactions, and the preliminary data that you shared with me showed that 9-digit commercial real estate deals closed the year very strong. In terms of numbers, December's biggest deals were up 44% over November. So that certainly says to me that there are signs of confidence heading into the year, and that those deal closures in December were probably commensurate with the spike that we saw in the index back in September and October, because the components of the index, the things like appraisal demand, environmental due diligence, and property listings, those all predate deal closings by, 1, 2, 3 months.
It was a very interesting divergence, I would say, in what we're seeing. You saw a dip in activity, and it's very encouraging that that dip was modest compared to other Decembers. I'm heartened by that. But at the same time, we saw just an enormous spike in these 9-figure deals, even falling to the range of 50 million to 100 million. It was a December to remember, to steal that Lexus line that you see endlessly on TV during the holiday season. But it seems like something was happening on the big side. I don't know if people were resolved to put away problem assets before the year end, if they wanted to roll over capital so they went into the new year with fresh powder. I don't really know, but the number of 9-figure transactions or anything above 50 million was up to its highest level of 2026. So a lot going on. I hope we see this big bounce that historically we've seen in January. I think it makes the January index numbers really, really important. In fact, I can't wait to see them come out in 3 weeks. That I think this will be really telling for what the confidence level is for the CRE market heading into 2026.
Totally agree. So our reports on the December index and the transaction tracker are coming out in the next few days. So they'll have more details on what was behind those numbers and what we're expecting to happen this month.
Great. Time for our Did You Know for the week. Dianne, what do you have for us?
So for this one, Alyssa, I'm pivoting a little bit away from market trends to talk about artificial intelligence. It's such a hot topic. We have clients coming to us asking what everybody else is doing because they don't want to be left behind. So we just closed our first AI industry benchmark study. We focus specifically on the environmental due diligence sector, and we wanted to know how often folks are using it and what they're using it for. So early results here show that 19% of our survey sample use AI tools regularly. Regularly means every day. So that's 19%, and another 20% are touching AI tools only weekly. Those who use it, they see value mostly for the time-consuming, tedious tasks, like these are the folks doing property research to see if a parcel has a potentially high environmental risk. They're using it to review 100-page documents quickly. They're using it to flag any changes. They're using it less so for tasks like interpretive or opinion-based determinations. And what really came to the surface was serious concerns about liability. So they're not comfortable using it for environmental risk determinations. They have concerns about privacy, concerns about accuracy. So I think in this segment of the market, it's really early days. So we'll be summarizing those results over the next couple weeks or so.
I think that we're at a point with the AI where it's becoming clear where the winners and losers will come from. I think we've been at this, and this is a little bit of a shameless plug, but we've been at this for more than a year, several of us here at LightBox, where banks have come to us and asked us to use large language models and AI to extract data from their own historical appraisals and use that data to set up databases that can be mined when a new appraisal request comes in. So let me give you an example of this. Somebody is looking at an appraisal, a new one for a 400 unit apartment in Charlotte. The bank knows that they've seen 18 loans over the last 18 months on similar sized apartments in the Charlotte MSA. It's not hard to connect the dots and say, how do we compare on this appraisal on things like cap rates, discount rates, sales comps, price per unit, things like that. And we have people adopting this already. People have utilized this software and our client base is growing all the time. But the gulf, I think, between winners and losers will be the people that are left behind are using it, but are using it to fill a one-off. I need to have an answer for this very quickly. I used to use Wikipedia or I used to use a Google search. Now I'm using AI. Tell me what the average sales price for apartments are in the Detroit MSA, right? The more sophisticated people, the people that are the winners, those that have better efficiency, better outcomes, perhaps smaller losses, better risk management, will be those that connect the dots. And those that connect the dots are actually not just building AI, they're building an infrastructure, a database, something they could mine instantaneously that's really well organized. And I'm not sure that that's been fully understood by people. They talk about AI, and I think if your journey on AI stops with everybody has chat and they use it to save time, you've kind of eventually fall into the bucket of people that are not winners, that you haven't exploited this to the level that it could be exploited.
Right. And there's certainly a lot to play out here, and it's early days. I think from the folks I talk to, some do use it the way that you just described, as a better tool for conducting research, for finding some short-term fact or answering some quick question. Whereas others are thinking of it more as like using it as an agent, designing functions around it. And to your point, are the more sophisticated ones. But a lot has to happen, I think, before it's more widespread and certainly getting a lot of attention. And it has enormous applicability. So it's something that we'll be watching very closely.
Okay, let's jump to the CRE stories making headlines this week. Manus, kick it off with multifamily for us.
Well, I'll start with a kind of overview of things. In my urgency to be half full, sometimes I do neglect this part of it, that multifamily, while we do see a lot of transaction activity and big sales taking place all the time, it is still a market that is trying to heal from some significant damage that was brought on in 2023 and 2024. What was that damage? That damage, some of it was unforced errors, people taking out floating rate debt and paying top dollar for properties. That is one part of the market. But what I'm really talking about is the fact that in so many markets, especially in the Sun Belt and other hot markets, what we saw was the run-up of value and enthusiasm for COVID-driven migration leading to an enormous amount of new starts, new building, new inventory. And that damage to rental rates has been real. And I'm looking at some data right now for just how bad this has been. I wish I had the source of this data. I will come back next week with the source of this. I don't have it in front of me, but the markets with the deepest rent cuts through the third quarter of 2025, these are so meaningful. Denver, the Denver MSA, almost 8%. Austin, 7.5%. Phoenix, 5%. San Antonio, just about 5%. Las Vegas, almost 4%. Lots and lots of markets that were heavily invested in 2023 and 2024 are still paying the piper in terms of an inability to see rent growth. And this is a little dated. It's as of third quarter. So we've seen a little bit of a rebound in Q4, but it is something that multifamily remains, at least for operators in these markets, still a glass, perhaps a little bit half empty, that until this inventory is completely absorbed, that those markets will continue to have to just muddle through. What do you think, Dianne?
Yeah, it's interesting, Manus. Multifamily's really been at the top of the list of a lot of metrics that we track here at Lightbox. Top of the list in terms of properties coming to market, top of the list in terms of the transactions that your group tracks, healthy interest from investors viewed largely as low risk, certainly compared to other asset types like office. But the data that you just cited shows that rent growth isn't necessarily increasing. And some of these are metros where developers came rushing in post-COVID as people migrated to them. You maybe are too modest to talk about the Diana Olick Property Play article that you and Ryan Severino were both quoted in this week. And the article really highlighted, I think, some salient points that because developers rushed in where folks were migrating post-COVID, new supply hit the market. And some of those residents didn't stay put. And that I think came as a surprise to some investors and developers. So the data points you just talked about are the signs and the proof that rents are adjusting accordingly, that migration-driven demand can be real, but it's not always permanent. So it requires investors to revisit rent growth assumptions to make sure that they make sense. And it's a process. The metros on the list, Austin, Phoenix, Orlando, they've got some excess supply that really has to be worked through before those markets come back to equilibrium.
The good news out of this is 2025 saw a real decline in the velocity of new starts. So this inventory overhang should improve over time. We should see this digested. But I do think that perhaps some of what we're seeing right now is some of these builders misreading the tea leaves on migration, that these people coming from Illinois, Michigan, Indiana, New York, New Jersey, et cetera, they were not just looking to move physically, they were also looking to downsize and save money. And maybe that meant selling their 2,500 square foot house in Connecticut and renting not a 3-bedroom luxury complex in North Carolina, but something that was more garden style apartment, lower, save some money level. So I think there's probably some of that going on as well, that the migration story was a little bit different than people were expecting. I do have 2 sales here I want to talk about. The first one from Silicon Valley Business Journal. These are 2 happy stories. Claire Fonstein, I think it's the first time we're referring to her, hopefully the first of many. In San Jose, the Ascent apartment complex sold for $325 million. The buyer there, Ethos Real Estate, paying almost $500,000 per unit for the 600-unit luxury complex. The seller there was Shea Properties. Why did I highlight this one? 2 reasons. One, the headline for the story said AI boom is pushing up rents. This is one of the most expensive multifamily deals in Silicon Valley from last year, but also that $500,000 per unit price tag is well above the 5-year average for apartment sales. The 5-year average was below $460,000. So we're talking about an 8% premium on the sale to what we've been seeing in that market historically. The second one, this comes from Mark Stiles of the Puget Sound Business Journal. In Seattle, the Jackson Apartments were acquired by Timberlane Partners. They paid $173 million to Vulcan Real Estate. This marks Timberlane's largest acquisition in 14 years. So when we talk about big deals getting done late in the year, these are a couple of examples of what we saw.
And certainly they're happy stories, Manus. In the context of the rent growth declines that you just talked about, rent growth in San Jose was outperforming. It rose 3.1% year over year, and that's well above the U.S. average of only 1%. And in Seattle, rent growth was more in the area of 2 to 3%. So not as strong as San Jose, but certainly above that U.S. average. And specifically in Seattle, multifamily transaction volume has more than doubled year over year. So those are 2 hot markets and 2 examples of deals that closed in areas where the buyers don't necessarily have to worry as much about rent growth assumptions, but things can change, as we just talked about.
Seattle is a happy reversal. We spent 2020 to about 2023 talking about A, quality of life issues, and B, the fact that firms like Amazon, Google, and Microsoft were all reducing their emphasis on the Puget Sound area. They were giving back space hand over fist. They were looking to reduce their workforce. In the case of Amazon, they were looking to diversify into a second headquarters. People want to reestablish that workforce in Seattle, where we know it's a talented workforce.
Okay, let's transition over to our office headlines for the week. What are you saying out there?
Well, sadly, it was largely more of the same. I'll go through this very quickly. The story here is the number of sales we saw in December, where the loss from the previous comp was sizable and, real damage was reflected across many different markets. So I'll run through these in short order. In Chicago, the Boeing headquarters sold for $22 million. This is 100 North Riverside Plaza. It last sold for $165 million in 2005, a loss of 87%. This comes after that sale fell through before. We had a previous buyer who was going to pay $25 million. That sale fell through. It now sells for even lower. In San Francisco, 100 Mission Street, last time went for $163 million in 2018, now $82 million. In New York, 100 William Street, $167 million in 2013, $70 million in late 2025, a 58% dip. In Boston, 99 Bedford Street, $50 million in 2019, $19 million in late 2025, a 62% dip. So, by the way, we have all this data in a spreadsheet. If anybody wants to, we'll give this away as a freebie. If people want to reach out to Alyssa or Dianne or I via LinkedIn or email, let us know. We're happy to share this. What we collected was the litany of offices that sold in Q4, that once sold for more than $50 million, that resold in Q4 for a loss of 50% or more. So if you're interested in that data, let us know. Happy to ship that around. But Dianne, it seems like really no end to the office narrative, which is pain, pain, pain.
I know it's really hard to listen to these numbers, but we won't get recovery without deals like this that really reset values. And what you just did was run through offices, some in good locations, and the investors are getting it for a song if they're courageous enough to rush in. And the other thing that jumps out is, the analysis shows it's not a one city problem. And I looked at the vintage of these deals. A lot of them were buildings that were bought between 2013 and 2019. They were bought at peak confidence. They were bought during days of cheaper debt. They were bought in a very different world for office demand before that global health crisis hit. And, for these properties, some may have a very different future. Some could end up being an office building that's more bright and shiny than it is now. Some could be something entirely different. It's a painful process, but a necessary one.
All right, Manus, we have time for one more here. What are you seeing on the development front?
Well, I use the term over and over again, and I've been using it since last summer, that the market is confident. What does that mean? Confidence means developers are willing to put shovels in the ground or embark on capital-intensive projects like conversions, and lenders are willing to make money available on these projects. And we saw two headlines, both in New York this week, that I will highlight. I liked both of them. The first one is from Andrea Zander from Institutional Real Estate, Inc. A lot of people were reporting this, but Ms. Zander's reporting is the one I saw first, so I'm going to give her credit there. A JV between Slate Property Group and Breaking Ground have acquired the Stewart Hotel, which is near Madison Square Garden. They're teaming up to convert the hotel, which is vacant right now, into an affordable housing project in Midtown West. The sellers there, Sioni Group and the Chetrit Group. The hope is, after paying $255 million for this property, that the new ownership will convert it to a 580-unit housing community. This should be welcome news to New Yorkers. More housing. Anytime you're putting up more housing in New York, it's a positive sign. Rents remain at near record highs in Manhattan, and any new inventory is good inventory, in my opinion. I have two others, Eden Ofer and Nathan Berman, are looking to convert 101 Greenwich in the Soho neighborhood to a 600-unit luxury apartment complex. They have filed plans to convert this from office to resi. And lastly, this story comes from Jake Indersky. Avdu has purchased a 12,000 square foot development site at 68 King Street in Lower Manhattan for $63 million. They got a $40 million loan from Valley National. They are looking to develop a 200,000 square foot high-end residential project. So confidence abounding in New York. You see this in South Florida. You see this in San Francisco. You're seeing some of this in Los Angeles. So people are feeling good about deploying capital right now.
Yeah, for sure. And the Stewart Hotel example that you gave is a great adaptive reuse example of a hotel being converted into something more at the affordable end of the market. But I think these are all examples that prove the point that Spencer Levy was making in his webinar, that deals work when the math works, and the math works if there's financing. And in the case of New York City, multiple layers of state and city financing, tax incentives, subsidy programs. I wanted to take a minute here, Manus, and also tip my hat to another reporter, Peter Grant at the Wall Street Journal, went live with an article earlier this week on another metro as D.C., and he characterized Washington, D.C. as a mecca for office to resi conversions. The article noted that there are more than 6,500 housing units in the pipeline there, and that's second only to New York City. So I started my career right after college working in downtown D.C. for an environmental consulting firm, and I spent so much time in an old, dusty U.S. EPA headquarters building with no natural light, and now DC's got vacancy rates in buildings like that are near 23%. The city's moving aggressively forward on tax abatements and C-PACE financing. So, I think while it doesn't necessarily have the subsidy paths that New York City has, developers are certainly moving in, and I expect we'll see more headlines like the stories that you just covered happening in Washington, D.C.
I have to say that Stewart Hotel one really gave me a lot of nostalgia. The thought of being able to live in an affordable apartment and having a 3-minute walk to Madison Square Garden to go see the Rolling Stones or the Who or the Rangers, it's like a dream come true for a 24-year-old Manus Clancy in the 1980s. I mean, I can only imagine how much money I would have spent seeing concerts and Ranger games and college basketball. It makes my heart race, the thought of it, actually.
I thought there's a demographic trend where folks are retiring and moving from suburbia into downtown areas so they can walk everywhere. So maybe that's in your future, Manus.
Before we close, Dianne, I know you have a shout out for one of our loyal listeners.
I do. I was really happy to get an email this week from Neil Chandler. I've known him for a long time as an environmental consultant, and now he works at Link Logistics. He's their vice president of environmental diligence and compliance, and Link is a subsidiary of Blackstone. So you'll be happy to hear, Manus, that Neil tunes in every week and said, and I quote, "We do an incredible job educating those like him that just don't know a lot about the institutional investor perspective." And he even listens to us in the car with his wife as they bring their kids back to college. So thanks, Neil, for reaching out.
And with that, we'll close. Thank you to our producers at Bruning Media. Please join the Lightbox team every week as they share CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great week.
Let's go.